remember when we had the technical recession that was not a recession? That was the first and second quarter. So you tend to see the weakest quarter of the year tends to be that first quarter number. So, having it be negative, especially now with, another full month data to go, isn't altogether surprising. And then you layer on what you're talking about, which is front running the imposition of tariffs. And honestly, I thought that would have been a factor in the fourth quarter number, because it's not like anyone wasn't aware throughout the entire campaign that Trump was going to impose tariffs as soon as he came into office. So I expected on November 5th that businesses would start to import ahead of the tariff imposition. And for whatever reason, the fourth quarter, you didn't really see any of that. So if anything, they're scrambling now because maybe they didn't take him seriously. I don't know. And now they're really rushing to bring in as much as they can ahead of the tariff threat. The interesting thing, though, is that presumably, if you're importing goods in anticipation, bringing forward, let's say, your purchases, you're basically bringing them forward into inventory. So what the trade numbers take us away, inventories should offset that, I guess is my point. So if you're importing and that's a drag on GDP, then if you're putting it into inventory, that should offset it because inventories obviously are additive. So the fact that that's not really what's happening, as evidenced by minus 1.5% estimate, suggests that there is some more broad weakness in the economy. And you and I have talked about this for ages. My focus is the consumer. And by any variety of measures, the consumer has been in recession. I look at consumer spending deflated by prices. And when you look at things like retail sales, which obviously is mostly discretionary consumption, and you adjust it for the increase in prices, what you find out is that unit sales, the actual number of things people are purchasing, has declined for over 2 years now. I mean, you never see anything like that outside of a recession, and not just a garden variety recession, but a really significant recession. And then other things, you'll relate to this. I view spending on your pets as sort of non-discretionary. This is the last thing you're going to cut. And if you go and you look within the consumer spending numbers at pet spending in particular and deflate that, what you find out is that's been negative year on year for 28 months. So clearly the consumer's under duress. And you see that in a variety of things, credit card delinquencies obviously being the most cogent, but also in the latest batch of consumer sentiment and confidence readings where, they had sort of this bounce on the election and this sense that, okay, now we've got to change and maybe the economy will improve. And that, I guess, patience was very limited with that. So we're 2 months in and the consumer's already saying, hey, where are the lower prices you promised and the better jobs and wages and all of that? So clearly the consumer is still struggling and not getting any relief in terms of inflation. So, what I'm getting to is that it's not just a front-running tariff story that's holding down GDP, but it's a continued pressure on all the segments of the economy that have been suffering heretofore, which is, these consumers and small and mid-sized businesses. And I don't see where that really is going to change absent substantially lower interest rates, and we don't seem to be getting that. The one thing that really got everyone's attention last week was the sharp downward revision in the Atlanta Fed's GDP estimate, which was on Wednesday of last week 2.5%, and on Friday it fell to minus 1.5. So that's a fairly sharp revision. I went back and looked because I'm a nerd at whether we've ever had a one-day swing in the forecast of that magnitude, and we have, not surprisingly, during the whole COVID whiplash experience where growth was forecast to be down 35% and then was up 10% and all over the place. The only other time we've seen any numbers this dramatic were also in the first quarter, which tends to be extremely volatile for reasons that should be obvious because you come off of a really holiday inflated end of the year and it tends to wreak havoc with the numbers because the statisticians can't keep up with the seasonal swings. But obviously the Atlanta Fed number was just a reflection of this barrage of much weaker economic data that we've seen over the last several weeks. And as you alluded to in the outset there, that weaker data has come alongside signs that inflation is reaccelerating. And I know you and I talked about this in prior conversations, where we have this sort of stagflationary backdrop where the economy is clearly decelerating, but prices are sticky. And, it's putting a lot of stress both on consumers and businesses. And, as relates to the latter, this potential increase in tariffs that we're going to see in the next few days obviously only compounds the problem. So we'll see how all that plays out. But, my broad takeaway is that we have this situation where the economy is clearly under stress and inflation is sticky, which is probably going to limit the Fed's capacity to rush in with the fire hoses, which would be their natural tendency. And that should be a real headwind for the markets. So up until last Friday, it looked like that was in fact starting to be the framework that investors were starting to say, look, clearly things are decelerating, but the Fed's hands are somewhat tied. So we might not get the reaction function that we're used to. And that's bad news until, of course, Friday, when all sins were forgiven. So we'll see what this week holds. Obviously, we got another barrage of data to digest this week, punctuated with a payroll number on Friday. So I suspect that we'll be due for a little more volatility this week and maybe a little less volume as people wait to see what that Friday number gives us. Clearly, Scott was aware that the economy was slowing. I think has been all along that the economy is substantially weaker than the data had indicated. As to whether he is able to persuade Trump toward your idea that he should really let people know, like, we inherited a mess and it's going to take a while to get through it. But he needs to really drive that home as to how it relates to the average person out there. What he needs to do, as you're suggesting, is to then tell people, like, it's going to take, let's give them a sense as to, how long it's going to take before they're actually going to see some relief when they go down to the grocery store, fill up their gas tank, or in terms of better employment prospects, etc. Because that's another thing that really took a hit in those confidence and sentiment measures. It wasn't just inflation going up, but inflation was going up at the same time that employment prospects or labor picture was deteriorating. So that's a pretty bad combo. And I think, there's some concern with the Doge stuff that they're just going to walk in there with a chainsaw and just cut, and that's going to impact people, throughout the economy, because it's not just people who work for the federal government, but then you have, independent contractors and their workers, etc. So there's a lot of concern and insecurity out there that he really needs to speak to. But ultimately, the problem is that these problems can't be solved that quickly. It really is going to take time, and it's going to take pain, and nobody has an appetite to take any pain, least of all politicians. So this is the struggle, I think, is that the markets got very excited about the idea that Trump was going to come in and cut deregulation and cut taxes and kind of remove these tethers from the private sector that have been restraining activity. And he's trying to do that, but it's not that simple. There's a lot of issues for him to deal with in terms of getting all this done. And then, there's immediate things like if you think that there's going to be enormous saving from slashing all these redundancies in federal agencies, well, you may lay off however many thousand people, but you're still paying them severance for a short period of time. Right. So they just go from collecting a paycheck to collecting, some other support. And then eventually, if they can't find a job, you're paying them unemployment. So they don't just disappear from the government dole. They just kind of changed the label that they're categorized under, at least initially. So, even the best things that are being implemented long term will be great, but the process of getting from here to there is going to be painful and, not smooth and easy. And the markets seem to have been discounting this immaculate reversal to a vibrant economy. We need to expunge the excesses that have been built up for so long here and take the pain. And the fact that he's not running for re-election gives him the perfect opportunity to take that pain. But maybe he feels like, I'll take that pain, but I want to take it after the midterm so that we at least establish a strong foothold here. And then we can take the pain after, and that's fine. You've got an economy that is kind of crumbling under the weight of higher interest rates, but the Fed can't provide relief because the inflation numbers are still sticky. Not only are they above the target, but they're moving rapidly higher. On an annual rate, we're running at 4.8% on the CPI now, annualized. So 2% is way off the radar. And obviously you're seeing things like, egg prices going up and whatnot. And then you've got the unknown of how the tariff thing fleshes out. I mean, it wasn't inflationary in terms of feeding through to the CPI in the first Trump administration, but that doesn't mean that it will work out the same way this time. I suspect it will, just because, the inclination of China and Canada and Mexico and whatever to offset, to try to take the hit on their end rather than passing it on to US consumers would presumably be even higher today than it was back then, just because their economies were in better shape back then than they are today. So they're in a economically weaker position, but who knows? So I think the upshot is that it's going to be really hard to navigate this in terms of threading the needle of getting the economy not to go into recession before the midterms and or the stock market not to decline before that. And that is why, the one thing I wouldn't be doing right now is making big bets. It's like we live in a world where uncertainty abounds and the market is priced for perfection. And I'm not just talking about stocks. I mean, look at credit spreads. They've started to edge higher. And interestingly, they did so even on Friday when the stock market had that rip snorting reversal. Credit spreads continued to widen and junks and investment grade bonds continued to move higher in yield. So maybe that's a sign that credit investors anyway are starting to get a little antsy about the outlook. The one most succinct conclusion we can draw is that the economy is probably decelerating and potentially going into recession, and the market has allowed zero room for economic error. It just seems like a very fraught and risky situation. I'm going to remind the audience, because there will be people who will berate me for having been negative on stocks forever, and I have been, because it's a bubble and it has been a bubble for a long time. But what I recommended people do was get into gold, and gold outperformed last year. It's outperforming this year. So I would continue to be long gold. Last week's action notwithstanding, I mean, I think that was just kind of, the weak hands exiting the market. People who had been speculating in gold who felt like, okay, it's gone as far as it can go. And at the end of the day, what we're talking about is an environment where it's going to come down to a contest of which lever are we willing to pull? Are we willing to let interest rates rise to a natural, acceptable rate to finance $36 trillion in debt? Or are we going to artificially attempt to suppress the backup in rates to keep the economy from absolutely imploding, in the process cause the dollar to be the valve for the sins? If the Trump people are now pointing to the Treasury market as the barometer of their success, the last thing they're going to want to do is see Treasury yields moving back toward 5% on the long end. If that's the arbiter of quality policy by the Trump administration, I would be very doubtful that they're going to let rates, rise to the levels that a natural supply to demand dynamic would require. I do see the dollar being the valve, and that's why I've been in gold all this time. And I think that's why the BRICS countries are all plowing in there as well.